Good afternoon, everyone. Welcome to SGX SICOM Rubber Futures and Options webinar series. I'm Kenneth Ng from the Singapore Exchange, and I'll be the webinar host and moderator. Today's webinar is on SGX SICOM Rubber Options Trading Fundamentals, Options Pricing, and Hedging Strategies. And the speaker for today is Mr. Patrick Yeo from Straits Financial Services Private Limited. Before I hand over the presentation to Patrick, I'd like to give you a short update on SGX. Webinar disclaimer. Please take note of the disclaimer pertaining to the collection and use of information that you have provided, prohibition of use of information in this webinar by individuals and entities located in certain jurisdictions, and disclaimer of guarantees, representation, and warranties in relation to this webinar. A copy of this disclaimer is available on our website. There are 4 webinars in this series. If you have missed any of these webinars, you may visit our SGX YouTube channel for recorded version. Next, I would like to give you a short update on SGX and our products. SGX is an integrated securities and derivative exchange in Singapore. The exchange was formed in 1999 following the merger of the Singapore Stock Exchange and the Singapore International Monetary Exchange, or SIMEX. SGX is also a listed company, and our shares are listed on our own SGX Securities Market main board. We operate Southeast Asia's largest stock market with a market capitalization of over 1 trillion Singapore dollars. On the derivative market, we offer the most comprehensive range of Asian stock index, currencies, and commodities derivatives. SGX acquired SICOM in the year 2008. For some of you here from the rubber industry, you would know that SICOM was the rubber futures exchange in Singapore. After the acquisition, SICOM Rubber Futures is now traded under the SGX platform. Because of the long history and strong brand name in the rubber market, we still retain SICOM's brand name in our rubber futures products. SGX is headquartered in Singapore, and we are supported by 9 representative offices globally to service our global customers. SGX's commodities products can be broadly classified into these 6 broad categories. We have the world's most actively traded iron ore market outside China, where we trade an average of 12 million metric tons of iron ore a day. For more information on SGX commodities products, you may visit our website. SGX SICOM Rubber Futures is the global benchmark for the rubber industry. Our SICOM rubber futures prices are used by tire makers globally to price 75% of rubber raw materials. SGX rubber products can be broadly classified into 3 broad categories. For exchange-traded futures, we offer the world's only US dollar-traded TSR20 and RSS3 futures. We also offer the world's only TSR20 rubber options. In addition to exchange-traded futures and options, we also have 3 OTC rubber forwards based on standard Thai rubber, standard Malaysia rubber, and standard Indonesian rubber. Quick statistics on our rubber contracts. We trade an average of 45,000 metric tons of rubber futures a day. On very active days, the volume can be as high as 100,000 metric tons a day or more. We had a record month in March 2020, where we traded a record 1.18 million metric tons for the whole month. This is roughly about 10,000 lots of futures per day. This is a screen capture of the trading activity of our TSR20 rubber futures on the 2nd of April 2020. As you can see, all the contract months are traded and with good open interest. This offers hedgers the flexibility to choose the actual contract months to hedge their exposure. For calendar spread traders, the trading activities along the whole forward curve present spreading opportunities. These are our contact information. Please feel free to contact us if you need more information. I will now hand over the presentation to the speaker of today's webinar. Thank you.
I hope everybody can hear me, and thank you for tuning in again, especially those from overseas. I know most of us are working from home, or we're actually quite free at home. So it's very good that you tune in for this webinar session on the rubber options trading. So before I start, I want to thank you for tuning in, and also for those of my friends from overseas, yeah, from Cambodia, from Indonesia, Vietnam, India, Malaysia, Thailand, and so many, even Europe. Some of you have tuned in, I can see your names there. And I just want to say, and for my friends in Indonesia, especially, selamat datang, yeah. So today I have, my talk will be approximately 45 minutes. And because this option topic is a rather large topic, so I have a lot to tell you actually. You see, so many things to tell you. So I'll be telling you like options is like an insurance policy basically. Then I'll be talking about the basic concept of options, rights and obligation. What happens when you exercise an option? Then we're going to talk about the SGX SICOM rubber options contract, the specifications. How are the options traded on SGX? Something very interesting to calculate the option premium using the calculator. Basic option strategy, all right? And we also prepare a special slides for processors and consumers hedging using options contract. So I just want you to take your drinks, sit back, relax, and enjoy the webinar, all right? Options is like an insurance. All right, so if you have bought a new car, let's say if the car is $100,000, okay? When you buy a car, you need to pay for the insurance to insure your car from the insurance company. And assuming that you pay $2,000, Singapore dollars, to insure your car for 1 year. So the 1 year is the tenure period. The $2,000 that you pay to the insurance company is known as the premium. So in option trading, you also trade the premium, okay? And when you buy an insurance, you are known as the holder or the buyer of the option. The seller, the insurance company, whether they are NTUC or AIG, they are the seller of the options, all right? So what happened is that when your car, or if your car happened to meet an accident, and the repair cost is $5,000 or $10,000, are you worried or concerned? No, because you already paid $2,000 premium to insure your car. And the insurance company will have the obligation to repair your car to your satisfaction. All right? So what you are saying here is that your maximum risk is the premium you pay, $2,000, but the repair cost by the insurance company they have to bear is somehow unlimited. All right? So you send your car for repair, and the insurance company has the obligation, the seller has the obligation to repair the car for you. So in other words, you have limited risk, the insurance company has the obligation to repair, and he has unlimited risk. So options trading is quite similar to an insurance policy. All right? But options gives you the right to buy if you think that the market is going up. You haven't owned the contract yet, okay? It only gives you the right to buy or the right to sell. If you think that the market is going down, then you buy a put option, all right? So the definition of an option is basically a contractual agreement, okay? Contingently, or upon to buy or sell a particular asset, which is the futures contract, actually the underlying contract, at a specific price, which is the premium, within a time frame. So there's always an expiration date on the option. So in option, there are three things you can do. We call it your choice, all right? Number one is you can buy and sell the options. You can trade the premium, in other words. That $2,000, you can buy and sell, all right? The second choice is you can exercise an option. Exercise an option means you want to change your premium into the underlying asset. And in this case, it is actually the futures contract, all right? In other words, you can acquire a futures contract, whether long or short, by trading options when you exercise the option, all right? And of course, the third choice is after buying the option, you buy and hold. If you think the market is going up, you buy a call option and you just wait. And if the market doesn't go up, it actually expires worthless, all right? And of course, if you think the market is going down, then you buy a put option, all right? So once again, I just want to emphasize that exercising an option means to change your option into the futures contract at the strike price, all right? So basically there are two kinds of options, all right? Call options give you the right but not the obligation to buy the futures contract. The put option gives you the right to sell, okay, but not the obligation to acquire the short futures position. So the first question I like to ask is, then what? What is the difference between a futures contract and an option contract? Okay. In this webinar, you have to crack your head a little bit to make it interesting. All right. So can you tell me, since I cannot hear you, I will tell you the answer. What is the difference between a futures contract and an options contract? All right. A futures contract is a contract obligation. In other words, when you buy or sell a futures contract, you are liable for the 100% of the contract value. It is a contract, and the risk level is 1-to-1, meaning if the market goes up 1 point, okay, you probably gain $100. If the market goes down 1 point, you lost $100. So the risk level is 1-to-1. And whether you buy or sell, whether you are long or short a futures contract, there is a margin requirement that you have to pay to the exchange to support those positions. Whereas the option contract is different. Option contract gives you the right to buy. All right. You haven't buy the contract yet. All right. But it gives you the right to buy. If you are seeing the market bullish, you buy a call. And if you think that the market is going down, then you buy a put option. All right. And the seller has the obligation when you exercise it. All right. The only thing, or rather the big advantage of option trading, is that the buyer has limited risk. You just pay the premium. And the buyer does not require to pay any margin to the exchange. All right. So when you buy a futures contract, all right, you are actually seeing the market up. You expect the market to go up. So this is actually what we call the risk profile. Okay. On the right hand side here, this red line is prices going up. On the left hand side, prices going down. So what happened is that when you buy a futures contract on this black line, your profit and loss, depending on whether the prices goes up or down. On the right hand side, as long as the market continue to go up, you make money, you make a profit. But once the market start going down on the left hand side, you suffer a loss. All right. So, but the call option is different. The call option is that if you buy a call option, you are expecting market to go up. All right. So if you expect the market to go up, you have a choice to buy a call option or to buy a futures contract. But when you buy a call option, on the right hand side, if the market goes up, you make money. But if the market goes down on the left hand side, you have what we call a limited loss, because this is the amount of premium that you pay to the seller. So your maximum loss is actually the premium. So you may say, well, then in that case, option is a better contract. It has less risk. It is true compared to a futures contract. Okay, let's look at if you sell a futures contract. When you sell a futures contract, you expect market to go down. All right. So what happened is that the graph looks like that. Okay. In other words, on the left-hand side, if prices goes down, you make money. You make a profit. But on the other hand, if the market price start to go up, then there will be losses as well. All right. So if you are looking at the market going down, okay, you can also buy what we call a put option. Okay. And a put option, you're expecting market to go down on the left-hand side. You pay a premium again. All right. And if the market does go down, you make what we call profit, unlimited profit. But if the market goes up on the right-hand side, there is a limited loss for you. Why? Because you only pay the premium. All right. So these are what we call the big differences between a futures contract and an option contract. Okay, now let's go through some of the basic fundamentals. Because this topic is quite a big topic, I'm going to go through quite fast. All right. First of all, in option trading, the buyer always pay premium to the seller. Okay, just like when you buy a car insurance, you pay the money out front, the insurance premium to whether it's NTUC or AIG. All right, these are the two examples. I'm not promoting for any of them, but those are the sellers. All right, so there is actually what we call a cash outflow. The buyer's risk is limited to the premium he paid, and the buyer has the right to exercise the option. I don't know whether you remember, exercising the option means you make a claim to the insurance company to repair your car, or you actually change your option into the underlying futures contract. All right. So on the seller side, the seller receives the premium. So there is they actually generate income. All right. You collect the money. All right. But too bad you can't go for holidays now because of the lockdown, yeah? All right? And the planes are not flying. So, well, you can keep the money. Okay? The sellers has unlimited risk. And the sellers, also known as the grantor or the writer, has the obligation to fulfill when the buyer chooses to exercise the option. All right? So in other words, if you had a car accident and you go to the insurance company and you say, I want to repair my car, the insurance company has the obligation to fulfill, because he collected your premium, he has to repair the car for you. All right? The last line here, it says the option is a wasting asset. It becomes worthless when it expires. This is very true because the premium that you pay to the seller diminish over time. All right? So if you have paid $2,000 to a car insurance company, and 6 months later you sold your car and you say, I want to get back some of this money, they are not going to pay you back $2,000. They probably pay you $500 and say that, well, or $1,000 and say that, well, the time has left less than half a year, so you can still get back some of your premium. But what I'm trying to say here is that over time, if the market doesn't go to the direction you like, it expires worthless because there is a time decay. All right? And this time decay, the rate of this time decay is known as the theta. Okay? But today we're not going to talk about this complicated Greek, which will be covered by another speaker next week. All right? So in call and put options, there is what we call a directional play. Just like futures market, just like stock market, you can, if you think that the market is going up, you buy a call option. All right? You think that the market is going down, then you buy a put option, as simple as that. Okay? So what happened is that when you buy a call option or a put option, when you are buying an option, whether it's a call option or a put option, some of these things you must remember. All right? Always remember that number one, you pay premium to the seller. Okay? Number two, you have limited risk. The buyer has a limited risk to the premium he paid, but his profit potential is unlimited. And this is a big advantage of option trading. The buyer has the right to exercise. All right? Exercise means to change your option into the underlying futures contract. All right? So if you buy a call option, when you exercise your option, you get a long futures contract at the strike price. Okay? If you are seeing the market going down, you buy a put option, you exercise it, you become short futures. Okay? Please take note that when you exercise an option, your premium is finished. You forego your premium. Okay? When you buy an option, there's no margin requirement for buyers. Margin is actually a deposit to the exchange to support those positions. We call it a good faith deposit, or some even call it a performance bond. But you don't need to pay any margin requirement. Why? When you buy an option? Because you already pay the premium in full, you know. Okay? The only thing about when you buy an option, as the time passes, there is a time decay, and this hurts the premium. All right? So just now we say that if you see the market going up, you buy a call option. You pay a premium. If the market goes up, unlimited profit. Downside, limited loss. Yeah? So if you are seeing the market going down, then you buy a put option. Okay? You buy a put option, you pay the premium again to the seller, and if the market goes down, you make a lot of money. Always remember, when there is a buyer, there is a seller. And in this case, when we talk about the insurance policy, the seller happened to be insurance company, right? So the seller received the premium from the buyer. There is what we call a cash inflow, all right? The seller risk is unlimited, but the profit potential is limited by the premium he receives. The seller has no right to exercise. Okay, the opposite word for exercise means assign. That means when the buyer exercises the seller will be assigned. And when you sell a call option, you will get the seller will receive a short futures position at the strike price. And when you sell a put option, then you get a long futures position at the strike price. When you sell an option, whether it's call or put option, you are required to put what we call a margin deposit to the exchange. All right? And this margin requirement is calculated by what we call SPAN margining system. And SPAN actually stands for Standard Portfolio Analysis of Risk, that is calculated by the exchange. All right? You don't have to worry about the SPAN margining, and the exchange or the brokers will advise you how much is the margin requirement. All right? It's quite close to the futures contract. All right? Depending whether the option is in the money, at the money, or out of the money. But if you sell an option, the time decay benefit you. All right? As long as the market doesn't go against you, you happily collect the premium. So this is how it looks like, okay? When you sell a call option, you are expecting market to go down or at least not going up. So you collect the premium, and if on the left-hand side, if the market goes down, you enjoy collecting the premium. But if the market goes up, you have unlimited risk. All right? Similarly, when you sell a put option, you are expecting market to go up. If the market goes up on the right-hand side, you happily enjoy collecting the premium. That is your maximum profit. But should the market goes down on the left-hand side, your risk is unlimited. All right? So in other words, in option, you expect market to go up, you buy a call option. The person who sells you the call option expect market to go down or not going up. Okay? If you expect market to go down, you can buy a put option, but the seller of the put option is expecting market to not to go down, but rather the market to be stable or go up. So in other words, in option trading, if you think that the market is going up, you can buy a call option or you can sell a put option. There are two things you can do. All right? So I have to tap your brain again to make you do some thinking. What is then the difference if buy a call is bullish and selling a put is also going up, which you can see here? Buy call and sell put, they are both bullish directional play. Then what is the difference between buying a call option and selling a put option? If you can answer this question, today's webinar, 50% of option you have understood. So this is a very important question. All right, to help you out, I will draw the risk profile for you. When you buy a call option, this is the direction. When you sell a put option, you are also bullish. So I'm going to give you about 5 seconds to think, what is the main difference between buy a call and selling a put option? Okay, all of you are very smart. I think you got the answer here. When you buy a call option, the buyer pay premium. When you sell a put option, you receive the premium. Remember, buyer pays a premium, seller receives premium. What about the risk factor? Buyer limited risk, profit unlimited. Limited risk, unlimited profit. Sellers has unlimited risk if the market goes down, but his profit is limited to the premium he receives. Right? Number 4, the buyer has the right to exercise. Seller has the obligation when he's assigned. Okay, when the buyer exercises, the seller has the obligation. All right? When you buy an option, there's no margin requirement. When you sell a put option, you have to put initial margin with the exchange. All right? So this is very important to know the difference between a buy call and a sell put. These 5 factors, if possible, remember very clearly in your heart. All right? That is why we have a asterisk here, a red little star here, which is a very important thing. You must remember. All right? Just now I mentioned that when you exercise an option, you actually change your option into the underlying futures contract. All right? Because today the options is on rubber futures. So the underlying contract is a rubber futures contract. So when you buy a call option, when you exercise, you get a long futures position. Okay? If the person who actually sell you the call option, he is assigned and he will receive a short futures position. Okay? Both will get it at the strike price. Okay? Or the exercise price. If you think that the market is going down, you buy a put option. If the buyer of the put option exercise, you receive a short futures position. The seller of the put option that has been assigned by this buyer will receive a long futures position at the strike price. All right? So please remember, exercising an options, you forego your premium. The premium that you have paid for the buyer side will be foregone, and he changed into a futures contract at the strike price. All right? And also please take note that only options that are in the money can be exercised. All right? Options that are at the money and out of the money cannot be exercised. I will explain this a little bit later. So to exercise an options, there are basically 3 kinds of style. Okay? European style options, you cannot exercise anytime. You can only exercise upon the expiration date. That means when the contract expires. Okay? Then they will check whether is your option in the money, at the money, or out of the money. Those options that are in the money will be automatically exercised. All right? Most of them are actually over the counter, but more and more exchanges now adopt European style options. All right? The rubber contract that we have is European style. All right? American style options can exercise any day. That means if you buy today the options, tomorrow onwards, before the expiration, you can exercise anytime. It gives you a lot of flexibility. All right? And a lot of American commodities are actually American, futures options contract are American style. All right? And Asian style basically is what we call, you can only exercise upon expiration, but usually it's based on the average month or a given period of time. All right? So please remember, European style exercise only upon expiration. American style can exercise anytime after you purchase the option. And please remember, only buyers of option can exercise. Here we are going to talk a little bit about what are the factors affecting option prices. All right. So in pricing of options, you need a few variables. Okay. You need the underlying futures contract. You need the strike price, also known as the exercise price. Remember that the futures prices goes up and down every day, but the strike price are fixed price. All right. You can choose the strike price. Then we have what we call expected volatility. Volatility is actually the magnitude, the speed and the magnitude of the underlying market movement. So, you know, recently the stock market has been very volatile. The S&P 500, the Dow Jones contract, you know, it goes up and down. Okay, those are high volatility. And this volatility can be calculated using standard deviation, all right? And the higher the volatility, the higher the volatility, the more expensive the option is. Okay. Next is the time to expiration. The longer the length of the option, we call it the tenor of the option. A 3-month option will be more expensive than a 2-month option because the time of expiration is longer. Then we have interest rate, which is the least important. We call it the risk-free interest rate because interest rate doesn't change every day. Huh? Yeah. And for stock options, there's another factor called the dividend yield, which is not applicable here in today's webinar. All right. So volatility is a very important or the most important component in calculating the option premium. And usually it is between 0.2 to 0.4 per annum, or it ranges between 20 to 40% basically. All right. For 1 year. And usually volatility, there are 3 types. One is the historical volatility, that means past volatility. Implied volatility is actually the current volatility. Okay, that means whatever the options you are trading right now, what is implying in the current market volatility. And the last one is expected volatility. This expected volatility is quite useful and important for market makers or for the traders because they want to know whether the volatility is increasing or decreasing maybe in the next few weeks or so. So they can actually calculate whether the volatility will be higher or lower. All right. This is actually the formula for calculating option premium, but we are not going to go through it. All right. With a calculator, with some of the free website, you can actually key in the 5 variables, you can get the premium. All right. If you have the expected or you have the volatility. So what we're going to do is that we're going to skip this because it's very mathematical and we don't need to know this actually. All right. Let's go through the SGX option contract specification very quickly. On the center column here, we have the futures contract, the TSR 20. All right. On the right hand side is actually the options contract, and you can see here European options. All right. What's the meaning of European options? Can you remember? Okay. Although I can't hear you, I think you know that options can only exercise upon expiration. All right. Contract size 5 metric tons, same as the underlying futures contract. Is available 11 months, whereas the futures contract is 12 months. All right. The reason why they have 11 months is because SGX settlement price, the last trading day is 1 month earlier. All right. So when we have a contract that expire, when you're trading the June contract, the last trading day will be the end of April actually. All right. 2 months before the option contract. Trading hours are the same, 7:55 to 6 p.m. quoted US cents per kilo. 0.1 is $5. Okay, this is important, huh? When we say that when there is a movement of 0.1, it is $5. In other words, 1.0 is $50. Okay, if it moves by 1 cent per kilo, it's $50. NLT or negotiated large trade, we call it block trades, which is mostly dealt in the option market. Minimum 20 lots. Okay, and we know that 1 lot is 5 metric tons. So 20 lots is 100 metric tons. Okay, and this 100 metric tons is actually a norm or a normal size that is traded in the physical market as well. Okay, when it comes to expiration, the settlement will be the underlying futures, which is the TSR 20 contract here. All right, and the strike price interval is 2 cents. Okay, 2 even cents. In other words, you can trade 114, 116, 118, 110, 110, 112. All right. So this, yeah. And please take note, the last trading day is the last business day before the last trading day, 1 month before the futures contract. All right. So what it means here is if you are trading the June contract, if you are trading the June option contract, the last trading day for futures is May. End of May, but the option is the 30th of April. All right, so it's actually 1 month, the last business day, 1 month before the futures. All right, so when you exercise or when the buyer exercise, he has the full month of May to trade the June contract still. All right. So again, let's have an exercise here. If you're trading the August contract, August option, when is the last trading day for the options? It is 1 month, 2 months here, the 30th of June. All right. Okay, let's do one more exercise. What happened if you are trading the November options contract? November, the last trading day will be the 30th of September. All right. Although the futures contract for November futures, it is the 30th of October. Okay, options calculator. You can actually calculate what is the fair value or the estimate premium by using what we call an SGX option calculator. And this option calculator is available on sgx.com. All right. If you don't know how to go to the calculator, you can call me up or you can call Kenneth, and we can guide you through. Yeah. So when you get into a calculator on an Excel spreadsheet, and you see here futures price. On the futures price, you key in the futures price. If the futures price is 114, for which month do you want to calculate? If you want a July contract, then you key in the July price, the futures price. Value date is actually the current date today. So today we are 9th of April, so I key in 9th of April. And the expiration date. Remember, when is the last date for July? July option, the last trading day will be the 29th of May, right? So we have gone through the exercise just now. So 29th of May will be the expiration date. You key in here. And immediately, it will tell you how many days. This option has a tenor of 50 days. It has a 50 days left. Okay, the number of days left is 50 days. Then we have interest rate. You know that recently the US interest rate has been very low and the Federal Reserve has cut the interest rate nearly 0%. So because this is a US dollar contract, we just key in 0.5%, half a percent, all right? And volatility, remember we talked about volatility earlier on? 波动性, volatility. This volatility is actually the underlying contract, and we estimate that the volatility is about 28%. So you key in 28%. Okay, you know, in the currency market, like dollar yen, the volatility is actually very low. It's only 5 or 6%. So you have to check roughly what is the volatility, and you can get this volatility using standard deviation, or you can look at the settlement price to get the implied volatility as a reference. All right. So once you key in all this strike price interval, you cannot key in because it's 2. Can you see the strike price here? 110, 112, 114, 116. These are called the strike price. So these strike prices are fixed by the exchange. And on the left-hand side here, can you see call option, the premium? So these are the premium. Different strike prices have different premium. All right. So every time you change your futures price here, your expiration date, your market volatility, the numbers of the premium, and the Greeks changes here. All right. So this is on the left-hand side, we call it the call option premium. On the right-hand side is the put option. Can you see the premium here? Okay, if the strike price is 114 and you have the strike and the strike price 114, which is the same price as the futures price here, you can see that the premium 4.71, 4.71 is almost the same. So you can see that the put option and the call option almost have the same premium. This option is called at the money option. Why? Because the strike price 114 is the same price as the futures price. All right. And on the right hand side here, you can actually key in your call option and put option to determine what kind of market volatility, or what we call it the implied volatility, is. All right. So if you are really interested in this table, you can always contact us, okay? But because of the time factor, we just want to show you that the calculator is available on sgx.com, all right? If you have time, log in later and calculate the premium. So I've actually calculated the premium for you here. if you see F here is futures price, the futures price is 114 and the strike price is 114. Okay, so the premium is 5.0. This option that has the same as the futures price, we call it at the money option. All right, and at the money option, we do not have intrinsic value. We only have the time value 5.0. And how much is 5.0 for 100 metric tons? Okay, if you buy 100 metric tons, okay, then you take $50 multiplied by 100 is $5,000 for every 100 metric tons. For NLT size, negotiated large trade, which is 20 lots, it is 5,000. So when you buy 114, you have to pay 5,000 US dollar. If you buy a call option, this is call option, all right? But you say that call option is very expensive, $5,000. I want to pay lower premium. So you can choose an option that is out of the money. Out of the money means the strike prices are higher than the futures price for call option. All right. So let's say if you choose 118, then you pay only 3.0, which is $3,000 for every 100 metric tons. And the out of money options does not have an intrinsic value. This 3.0 is actually, we call it the time value or the extrinsic value. Okay. Whereas, let's say if you choose 112, the strike price 112, the premium is 6.1 or 6,100. You notice that this option, the strike price is lower than 114, and the premium 6.1 is called in the money option. Why? Because this in the money option has intrinsic value of 2 and an extrinsic value or time value of 4.1. So if you take 4.1 plus 2, you get 6.1. Why? Because this option is in the money. The strike price, the call strike price 112 is lower than 114. And if you take 114 minus 112, you get 2.0, which is the intrinsic value. All right. So let's do an exercise now. What about this option? A 110 call option. The futures price 114. So this option has the intrinsic value of 4, but the premium is 7.3, you know. So 7.3 minus 4, you get 3.3 time value. You got it? Yeah. So what happened is that when you buy a call option, these are the premium that you can choose. All right. And if you remember the graph, you pay the premium, you have limited loss. But if the market goes up, if the futures price goes up, the premium goes up. So you have unlimited profit. Okay, I want you to look at the extrinsic value. I have one question here is, which of the strike prices has the highest extrinsic value? Extrinsic value is actually the time value. And it's very obvious that 5.0 is higher than the rest here. So the at the money option actually has the highest time value or extrinsic value. All right. Let's look at put option now. Put option is when you buy an option, you expect market to go down. And again, you pay the premium. All right. At 114 futures price, at strike price 114, the premium is 4.9, almost 5. We call it at the money option. Why? Because the strike price and the futures price are the same. But when the strike price is higher, the premium gets expensive. So the put option is actually opposite of the call option. In the money option, the strike prices are higher. Out of the money options, the strike prices, the premiums are lower. All right. So let's say if you expect the market to go down, then you buy. Okay, you buy a put option and you pay the premium here. So let's say if you choose this option, you think the market is going to go below 110, the rubber price, and you pay 3 cents per kilo. So 3 is $30 times 100 tons is $3,000 premium. Okay, so the premium that you pay here is 3,000, and the strike price you choose is 110 if you are bearish. All right. So the intrinsic value is actually the premium. Okay, the intrinsic value that you see here is basically the difference between the futures price and the strike price for options that are in the money, basically. All right, so if you take 116 and the difference of the futures price for put option, because the put option is higher price than the futures contract, you get a 2 point in the intrinsic value. All right, so extrinsic value is the time value, the difference between the premium and the intrinsic value. All right, so whether the option is at the money, in the money, or out of the money, it depends on what strike price are you choosing. Okay, for in the money options, at the money is very simple. When the futures price and the strike price are the same, we call it at the money. In the money for call, the strike price is lower, and for put option is higher, and opposite for out of the money. All right. So we come to the second last part of the option webinar, which is, we call it the option trading strategy. All right. Just now we calculated that for call option at the money is 5.0 and for put option is 4.9, almost the same. Okay. Why? Because the futures price is 114 and the strike price is 114. So on the left hand side here, we call it the call option, and the put option on the right hand side. The left hand side is these are the premiums. Okay, so when the market goes up and down, the strike price here in the middle doesn't move. It is the premium that moves. So when the 114 goes up to, let's say, 116 or 120, then all these option premium become increase in value. It become more expensive. Then the put option value will drop. All right. But when the market drops from 114 to 110, for example, then the put option, the premium here will increase in value. The call option will decrease in value. All right. So just now we talked about the risk profile. When you buy a call option, it is a bullish strategy. All right. So when you buy a call option, you pay the premium, right? Market goes up on the right hand side, unlimited profit, limited loss. Can you see here? So if you are trading futures and if you feel that it is very risky, because if the market goes down, then you can actually buy a call option because you only lose the premium. But if the market goes up strongly, your profit is unlimited. Similarly, the person who sells the call option, you call it sell the call option, short call, he receives the premium because he is bearish strategy. All right, he received the premium. Can you remember what happened? He received the premium. Sorry, profit is limited, risk unlimited. If the market goes up, you lose a lot of money. All right, so this profile you must remember. All right, let's look at the put option. The put option is a bearish strategy, and when you buy a long put or when you buy a put option, we call it long put. You pay the premium. Okay, your losses is limited if you are wrong because you are bearish, right? So market right hand side go up, you lose the premium. But if the market crash, you make a lot of money. Okay? By the way, this is your break-even level, the arrow here. This is the strike price. All right. So the person who actually short the put option, he is bullish. All right. He received the premium. That is the maximum profit he gets. But if the market crash, he has unlimited losses here. So you have to decide, whether if you expect market to go up, you can actually sell a put option and collect the premium, or you can actually buy a call option, right? Okay, another strategy, we call it the vertical spread. For those of you who attended my first session on Tuesday on the rubber trading, we talked about spread, all right? And in this spread, it can be applicable to option trading as well. And in this case, we call it a vertical spread, okay? Vertical spread means you buy call, you buy a call at a lower strike price, and you sell a call at a higher strike price. This is a higher strike price. This is a lower strike price. Okay. In this strategy, you don't expect the market to be very to rally a lot. You expect the market to be stronger. So you are slightly more bullish. Okay, so you buy a call at a lower strike price. You can buy call or buy a put, you can choose. Okay, at a lower strike price, and you can sell a call or a put option at a higher strike price. We call this a bull spread. All right. So you buy a call, you pay premium. You sell a call, you receive premium. Sell a call is like that. All right. So this is the net graph that you see because you are slightly bullish. When the market closes at a higher strike price, you make some money here. There's a profit here. But if the market closes at a lower strike price, you have limited loss as well. So this strategy is quite conservative in the sense that if you are slightly more bullish, then you put on a bull spread. If the market closes at a higher strike price, you make some money. But if the market crash or go lower than the strike price, you lose some money here. Okay? But this strategy is not bad. Why? Because when you buy a call or a put, you pay premium. Then you sell a call or put, you receive premium. So your net cost of the premium can be zero. Okay? Can be a zero cost option, or you can pay small amount of premium only. So if you are more bearish, if you are slightly more bearish, it's still a directional play. Then you buy a call at a higher strike price, and you sell a call or put at a lower strike price. We call it a bear spread. Okay, a bear spread means you expect market to be going down a little bit more than going up. So if the market closes lower, you make some profit. But if the market closes higher, limited loss as well. All right, this is what we call a vertical spread. Example of a vertical spread. Okay, can you see the strike price? If you buy a call, 150 is lower than 150. You buy a call, you pay a premium of 5.2. You sell 154 call, you receive 3.2. This is a lower strike price. This is the higher strike price. All right, because you pay 5.2, you receive 3.2. Your maximum loss is only 2.0. However, your maximum profit also 2.0. So if the market closes lower at 150 strike price, you lose 2.0. But if the market closes at a higher strike price, you make 2.0. So this is what we call a bull call spread. Okay, and you can use vertical spread using call options or put options. Okay, but they have to be the same classes of option. You cannot say buy call sell put. You have to buy a call, lower strike price or higher strike price, same classes of options. Okay. Okay, another option, we call it the combination. Okay, or we call it sometimes volatility spread. Okay, we can actually buy a call and buy a put at the same time. This strategy is very good when you think that the market is going up sharply, or if the market is going to crash. You don't know which direction, you're not sure, but you expect the market to have a big move. So you buy a call option, okay, buy a call option, and at the same time, you buy a put option. So buy a call option, if the market goes up, you make a lot of money here. If the market rally, okay, and the put option you abandon, that means it expires. But when the market crash, your put option make a lot of money, and your call option expire worthless. So this strategy is good if you put on a straddle, you buy call, buy put at the same strike price. But what happened is that after you buy call and buy put, the market doesn't move. What happened? It closed at the strike price that you buy. That means you lost both your premium call option and your put option. So it is a very expensive strategy. So long straddle, you expect a big move, but you are not sure of which direction, up or down. It's a good strategy. But if the market don't move, you are dead. Why? Because you lost both the premium. Okay? So the premium is quite expensive if you choose the same strike price. So what happened is that you choose out of the money option. Okay, you buy a call at a very high strike price, then you buy a put option at a low strike price. It's called a long strangle. Okay, but the market need to move a lot bigger to break out before you make money. So buy call, buy put, different strike price, we call it a long strangle. Okay, this strategy is less expensive but harder to make money. Okay, because you choose out of the money option, higher strike price for call, lower strike price for put. Okay, a lot of people like to do this combination by selling the straddle and the strangle. So you sell call, sell put, and you receive the premium. Okay, hoping that the market don't move, and if the market stay unchanged, you collect both the premium. So short straddle means sell call, sell put, the same strike price. You collect both the premium. But don't forget, when you sell options, you have higher risk. If either side move one direction, your losses are unlimited. All right. Some people like to sell strangle. Sell strangle means to sell a call and a put at the different strike prices. Okay, you still collect both the premium, but the market has unlimited risk if there's a big movement in either side. Right? Quite a popular strategy for traders. Okay, actually I've come to almost the end. The last part is basically some of the participants here come from rubber factories, rubber processing plant or suppliers. So I just want to say that the processor or those people who actually make rubber, they can use options to hedge besides the futures. All right. So if today, 9th of April, a processor has a buyer to deliver 500 metric tons of SIR, Standard Indonesian Rubber 20 in July. Okay, this is just an example that you are the processor and your buyer asks you to deliver, buy from you 500 metric tons to deliver in July. And the current price for July is 1.14 or 114. And the buyer agreed to fix the price at the end of June. Okay, although the price is 114, the price is not determined until the end of June. All right. So what happened is that the processor, because the processor is afraid that if the price comes down, by the end of June, he will be selling to the buyer at a lower price. So what he can do is that in order for the processor to not to suffer a loss, he decides to use the options to hedge. So in other words, the processor is afraid the market will go down, all right, by the end of June. So what he can do is that the processor is actually naturally long. He's afraid prices will fall and he will be selling at lower price to the buyer. So in option trading, if he expects market to come down, he can actually buy a put option. He can buy a put option or he can sell a call option. But by now, we know that selling a call option is quite risky, right? So buying a put option is safer. Why? We just pay the premium, and if the market goes up, we just lose the premium. But if the market goes down, you are properly hedged because your profit is unlimited. All right? So always remember, if you are a rubber processor, you are always worried about falling prices. So few things you can do is you can buy a put option, or you can sell a call option to collect the premium, or you can sell futures to hedge. All right? What about the processor? What about the consumer? A consumer is a tire manufacturing company. Okay, and today on the 9th of April, a tire consumer, okay, he contact the seller and he want to take 1,000 metric tons of SIR 20 again in July. Okay, the buyer agreed to fix the price based on the settlement price in end of June. So in other words, if you are a tire manufacturer, you are afraid that you find that the current price is quite attractive, and you are afraid that from now until June, okay, the price is 114, and you are afraid that prices from now until the settlement price in end of June, the price goes up, you will be buying at a higher price. So what happened is that the consumer is actually short of rubber. He needs to buy. He's afraid prices will rise and he will be buying at a higher price. So he can hedge by buying a call option, or he can sell a put option. Okay, so what happened is that an example here is that the consumer can buy a call option at 118. Okay, he can go to the call option and say 118 here, the strike price. Okay, the call option, yeah, 3.0. So he buy the premium at 3.0, assuming that he buy the premium at 3.0. Okay, And 3.0, how much does he pay? He pay 1,000 metric tons, okay? $30 multiplied by 1,000 ton, he paid $30,000 as an insurance premium, just to protect himself in case the market goes up. And we know that he buy the August contract because why? Because he only fixed the price in end of June, because August expire in June. All right. So on the 30th of June, assuming that the price of rubber already has gone up to 130. So the option actually automatically exercised into the futures contract at 118 because he bought the strike price 118. He get a long futures at 118. Okay. And since the futures price is 130, you can see that the difference between 130 and 118 is actually 12 cents per kilo. All right. So the consumer is long 1,000 metric tons of August futures at 118. So there are two things the tire consumer can do. Number one is he can sell at 130 and take profit. Okay. But don't forget, he paid the premium of 3, you know. So he sell at 12. He gained 12 points. He got a minus 3 point the cost. He make 9 cents per kilo net. All right. So 9 cents, if you multiply by 1,000 metric tons, $90, he make a hedge gain of $90,000. In other words, this will be a good choice that he saved $90,000 if he didn't buy the option. Choice number 2 is that the tire consumers, because he need the physical rubber, he can do an EFP. An EFP is actually an exchange for physical with the trader, with the dealer. He can sell because he already exercised. All right. So when he exercised, he already long, you know, long 1,000 metric ton of August futures. He can sell the August and buy the physical July by doing an EFP. An EFP is exchange for physical, exchange futures for physical. So he convert his August futures contract by selling the August futures to square off his long, okay, to square off his long here, and he buy the July physical and take delivery in the month. Okay. For those who are new, it sounds a bit complicated here, but you can always call Kenneth or myself to discuss about this, all right, if you are tire consumers, all right? So in short, basically, you want to buy a call option to basically protect against the price rise for tire consumers, all right? So I'm almost done. Some of the reference book in option trading are very good, all right? So if you can go to the library, or if you like an investment, you can always buy. I recommend the first book, Option as a Strategic Investment by Lawrence Macmillan, all right? It's a very good book. They talk about stock options, but the strategies are the same. It's written in a very simple English language, and it's a very good book, all right? You can go to the website and order this book, all right? So with that, I've finished my session. I thank you very much for your attention and for tuning in. And you can contact me at this email, or you can call me in my office and my handphone if you have any questions.